This morning, I'll just cover off the updated asset allocation publication, which should be in your inbox this morning. We have tweaked our asset allocation settings in light of some of the macro risks that have cropped up. And so I'll cover the three big considerations for us in terms of how we're setting our asset allocation over the next quarter. So firstly, it's the war in Ukraine. I think something that the last couple of years has really taught us is risk can come in many different forms, and often the source of risk is very difficult to predict, and that's exactly what we've seen. So from a broad macroeconomic perspective, the Russian invasion will add to already some of the high global inflationary pressures that we've seen, with significant impacts on energy and key commodities, just given they are the key export regions. I've shown there in the chart some of the key exports in the Ukraine and Russia, obviously with ports being blocked there and the access to the Black Sea. So it means that very little is coming out of that region. So no doubt the supply response from a lot of commodity producers will be quite swift, and it may alleviate some of the pressures in some of these key commodities. And in fact, in oil, that can potentially come on a lot quicker. But medium-term inflationary pressure risks are really heightened by this conflict. And although we haven't seen a broad bond market sell-off just yet, we've seen bond markets obviously tick higher. We do expect some of that inflationary pressure to really reflect on bond markets, and hence why we maintain our underweight stance on fixed income in general, particularly long duration bonds, just given some of those inflationary pressures that are cropping up. From an Australian investor perspective, and I think this is where we need to really focus on, whilst it's a terrible cost, the human cost with lives being lost over there in the region, we do benefit in a number of ways, just given Ukraine and Russia are some of the key export regions and overlapping with some of our key exports. So in terms of Russia, while it makes up only about 1.8% of global GDP, it is the largest exporter of natural gas. It's the second largest exporter of oil. It's the largest coal exporter, and Russia and Ukraine combined to account for about 30% of global wheat exports. So, obviously there's the overlap there with the Australian key commodities, and you can see there the chart on the left-hand side. It shows you the chart of the RBA's commodity price index, and you can see there that basket is actually weighted according to all our key exports, and that's at pretty much the highest level since records began in the early 90s. So what this means is we're getting a better terms of trade, higher national income, and that all flows through into the economy. Essentially, that will take some of the inflationary pressure off our economy, and also the economic recovery from COVID with the higher income coming up. So obviously the key risk is around higher inflation. So global factors will be a key risk to the economic outlook. So we are just mindful of that. And obviously the higher AUD can certainly hurt us, given Michael Knox's view of an increasing AUD, trending towards about 90 cents towards the end of this year. We do expect that to put downward pressure on some of the exports there. But bottom line is Australia's in a much stronger position to weather some of the fallout from the crisis in the Ukraine. The second major risk is China and the risk of the outbreak there. No doubt Matt might have something to say about this as well. But last Saturday, China's Vice Premier, who is the coordinator of China's COVID response, has said that their dynamic clearing policy, essentially their zero tolerance for COVID, will not waver and will not relax. In fact, President Xi over the weekend said something to that same effect as well. So we expect them to maintain essentially a zero tolerance policy to COVID. So we're expecting continued disruptions for manufacturing supply chains. While it has been quite minimal to date, it's inevitable given the COVID outbreaks in Shenzhen and Shanghai. They are the major export regions, manufacturing hubs as well as key ports. So we do expect to see that impact flow through into global supply chains. So given the spread of the virus, there's clearly a risk there that more major cities will implement some form of restrictions. We're seeing, in fact, COVID outbreaks reported in 28 out of 31 provinces around the country. So the economic costs, obviously, of controlling COVID in China will turn out to be a lot higher than, I guess, what authorities had first thought. We saw the global supply chains really impacted last year in August when the Ningbo port was put offline for 2 weeks. And remember, the flow-on effects for that on global supply chains continued for at least a number of months. So something that we're watching very carefully. And then thirdly, its third key risk is around inflation. We do start to cycle some of the higher inflation readings over the next couple of months. But as you can see here in these charts, there's, we've once again seen some of those inflationary pressures start to ratchet up. Shipping rates, the Baltic Dry Index, key shipping rates from China to the west coast of the US are again sort of ticking up. They're not back at, those elevated levels in the back end of 2021, but they are starting to tick up. Commodity prices have continued to rise, and also input costs in China. So no doubt that will flow through. The question is, does this change the outlook, I guess, for interest rates? The market's pricing at 6 to 7 rate rises in the US. The market's pricing about 5 rate rises here in Australia. So, there's a lot already sort of pricing in terms of higher inflation. While our outlook, we certainly don't think that's, it's enough of a swing factor to see interest rates dramatically ratchet up even higher from here. We certainly think, the market's probably about right. In fact, Michael Knox is calling for the first interest rate rise for the RBA to be in Q4 this year. So we do think, it may be a much lower trajectory than what the market currently thinks. But it does mean, given we are likely to see inflation start to tick up continually over the next few months, that we do have to position portfolios quite differently. So, what we've been talking about in equities, looking for companies with much stronger cash flow, a tilt towards large cap quality as well as resources. In fixed income, we've talked about floating rate credit, particularly with credit spreads still quite tight, ABS, asset-backed securities, as well as high yield, and then infrastructure, anything sort of economically linked to the recovery, as well as having their toll escalations or tariff escalations priced with inflation. And then, of course, getting access to gold and other real assets. So given in light of the risk, what we do know, we've seen multiple, I'm sure many of us have seen multiple variations of these charts and these figures, but the bottom line is, with all of these geopolitical risks that are coming about, they are notoriously difficult to predict. They come out of the blue, but and they often take a significant toll on assets initially once the event occurs. But what we see here is that typically after 6 months, particularly in the US market, it bounces back 5%, and after 12 months, it's back 9%. So markets, once they understand the economic risks, they tend to, and price that in, they tend to bounce back quite quickly. So geopolitical events tend to be quite short-lived. Not saying that it will be also this time, but it's a good gauge as to what we've seen in the past. But also what we know from this time around, look at all the asset class performance over since the start of this year. Global equity markets are down 10%. On average, the ASX is down 2.3%. We've obviously held up a lot better just given our commodities exposure. But also valuations are back from the market. The ASX 200 is now trading at 15.5 to 16 times. We're seeing investor positioning still quite bearish. Institutional investors at the moment, in terms of their absolute cash levels, are back to levels not seen since the GFC. In terms of their absolute risk exposure as well, it's also back to sort of GFC levels. So they are positioned quite bearish, whilst at the same time, economic fundamentals remain quite sound. You look at the G7 at the moment, what consensus is currently forecasting for GDP growth this year and next year. So this year they're pricing in GDP growth, and this is the most recent number, 3.7% GDP growth this year, and 2.2% next year. And compare this to what we've seen over the last 20 years on average across the G7, GDP growth has averaged 1.3%. So you can see that GDP growth is still well above trend, and the economic fundamentals still remain sound. You look at the economic surprise index across the world, it still remains in positive territory as well. So hence why we still remain, we have a positive view on risk assets. We still remain overweight equities, particularly Aussie equities. But what we have done is we've lightened our global exposure a touch this quarter, bringing it back to a neutral exposure. We see the impact of the war in Ukraine. The biggest impact will be felt across Europe, obviously with high fuel prices, the inflationary pressures hitting Europe, with the US less impacted by that, given they are a net exporter, and as well as Australia. So we do see most of the economic impact really hitting Europe there, and given the risks around China as well. So we just have pared back our global exposure just one notch, bringing it back to neutral. We have lifted our cash exposure up just a touch. We were previously underweight. We brought it back in line with the market. And we remain underweight fixed income, as I mentioned before. So our risk position is tilted around Aussie equities. We are very fortunate in the position we are, both geographically and with the access to resources. So the AUD, whilst we are calling for a higher Aussie dollar, has remained at the bottom of the range. So it does remain quite supportive of the Australian recovery. Secondly, we're not seeing the same inflationary pressures just yet compared to our global peers. We've seen our CPI number at 3.5% at a headline level. Compare that to the US, which is 7.5%. So we're not seeing the same inflationary pressures, which means that the central bank can afford to take it a little bit slower than other developed market central banks, which should be supportive for the recovery. Also, commodity and agriculture price strength will continue to take pressure off the federal balance sheet. So going into the budget next week, we expect a much stronger position, just given the state of commodity markets. And economic growth, as we know, in Australia remains sound. Economic employment remains at multi-decade lows. Balance sheets, which we saw through the reporting season, remain quite sound. And GDP is expected, like the rest of the world, to remain above trend for the next couple of years as well. So things look good for the Australian economy, and hence our overweight equity exposure, just given our sector exposure there.